I'm joined now by Rob Subbaraman, Chief Economist and Head of Global Markets Research at Asia ex-Japan at Nomura. Rob, great to have you on the show. Thank you so much for your time here at NDTV Profit. Let's begin with your take on where the US economy is headed, looking at the inflation data that has come in on one end and the promise of retaliatory tariffs escalating on the other.
Yeah, so I think the U.S. economy is really delicately poised right now. The growth data has been weakening. As you mentioned just now, this U.S. CPI was a bit better than expected. Core CPI came in at 0.2% on the month. But, we've dug into the details at Nomura, and a lot of the components that are relevant for the PCE deflator, which is actually the Fed's preferred inflation measure, more than the CPI, and that comes out in a few weeks' time, that is still pointing to a 0.3% month on month. In fact, we've raised our forecast a little bit for the core PCE. So I think it's too early to say, definitely too early to say inflation is coming down. The real risk for the US economy is growth slows down, but inflation reaccelerates. We haven't yet seen, it's too early to see the effects of tariffs, and tariffs raise import costs. And so there is a real risk that the US experiences in coming quarters slower growth and rising inflation, and that will make it very difficult for the Fed. At this stage, we think the Fed won't be able to cut rates. We have them on hold this year.
Right. So, Rob, clearly what you're saying is, with the number that has come in too early to actually predict something from here on, but with regards to Fed's action as well, are you sticking your neck out and saying that, yes, this could probably push back the Fed rate cut expectation from here on?
Yeah, we think so. I mean, right now, if you look at market pricing, it's the amount of cuts this year has increased to around 3 cuts. But we do think, there is, if you look more detailed into the pricing, we think there is a small camp that thinks the US economy is going to suffer a very deep recession and will have to slash rates very aggressively, 100, 200 basis points. And that's contributing to this market pricing of 2 to 3 cuts, because the market has to consider all the various scenarios, right? And there are these tail risks that are growing of a pretty bad outcome for the US. But overall, I would say our view is that the chances of the Fed cutting still remain low in our view. We acknowledge growth is slowing, and that's happening, but I think the markets are not focused enough yet on the inflation side. We are seeing signs inflation expectations are rising, and if the tariffs do lead to higher import costs and higher inflation, it's very tricky for the Fed to cut rates then, because it wasn't that long ago during the pandemic that when inflation picked up, the Fed was behind the curve. And the worst thing the Fed wants is a 1970s outcome of stagflation, where if they do cut rates and inflation takes off even more, and then they have to raise rates again at some point, and inflation stays high because it's got into wages and inflation expectations, the inflation genie will be out of the bottle. It's harder to get back in, and you've got weaker growth. And I don't think the Fed wants to take that risk.
Rob, there's a set of research doing the rounds on the impact of the Smoot-Hawley Tariff Act on US equities way back in 1930, right? And it talks about how when the tariff war did start, I mean, the markets took about maybe 6 years or 7 years before it came back to the levels at what it was when the tariffs came into being. Now, my question to you is, do you guys foresee the possibility that this could be a long, protracted, flat set of markets, maybe with a downward bias, if indeed the tariffs and the retaliatory tariffs from all regions continue?
So, Niraj, I'm not going to predict, if we're heading towards 1930s kind of equity outcome. That would be disastrous. I would say a few things. So one thing I would say is tariffs are very bad for economies and markets because they're a tax, and so they tend to raise costs and they hurt profit margins and consumer demand and growth. So you have inflation going up and growth going down. That's the pressure from tariffs. So it's clearly not good for markets. The second point I'd make is compared to back in the 1930s, the world is a lot more integrated now, and there's other much bigger economies than there were back then outside the US. And so I think, the other way this can play out, and I would bring India into this conversation, is that I think the US is particularly vulnerable to these tariffs and particularly retaliation, which we're starting to see from Canada and EU and China. But we could start to see, as US economic exceptionalism, if it starts to fade, we could start to see a focus on other big economies. And to me, India is in a very good position to actually attract capital inflows and do well. It is by far the fastest growing of the big economies around the world, around 6%. I think it could be even higher than that in the coming years. Inflation looks like it's increasingly under control, which allows the RBI to cut rates. We expect 75 basis points cuts this year. And, India is not so exposed to this tariff war. It's not so integrated into all these global supply chains as a Korea or a Taiwan or Singapore. And it's a relatively closed economy because it's so big. Over $4 trillion US dollars of GDP. Its domestic demand makes up much more of that GDP than exports. Very different to a Taiwan or a Singapore or a Malaysia. And so I think India can handle the tariffs better. And it's a good counterweight. It's a big economy. It's a good counterweight to the US and China. So, bring it all together. I think there's not many, but I think India could be a relative outperformer in the coming years if this tariff war continues for many more quarters.
So, no, interesting point there, Rob, in terms of India. Just want to understand, we had our own inflation data out yesterday, 7-month low. Food inflation at a multi-month low. The IIP came in better than expected as far as India is concerned. And couple that with the Trump trade coming off. Does this bode well for India in terms of flows, equity, and economy?
Well, I mean, the Trump trade war is not good for India or any country, but I think on a relative basis, India is less effective. I think, if anything, this tariff raises increased tariffs around the world is going to slow Indian exports. Indian exports already look on the weak side, as does for all countries. And so it does provide more scope for the RBI to potentially cut rates going forward. So, I think that's a positive. I'd say the other thing which I'm impressed about over India is on the government side, the fiscal side. I think looking back now, they've done a great job in terms of being prudent around fiscal. They have not allowed the budget deficit to blow out in recent years, unlike many countries around the world. And so I think there is room to expand fiscal policy if they need to, if the global, the external backdrop deteriorates further.
Right. So that's with regards to, how India is positioned as well with regards to the macro data. Thank you, Rob, so much for speaking to us at NDTV Profit.